Hello, I'm Andrew with Jesani Wealth Management. And late last year, so in late 2022, Ray Dalio left his hedge fund, Bridgewater and Associates, which was actually his fund that he started in the 1970s. And it turned out that Bridgewater is, until today, the most successful hedge fund ever. So Bridgewater returned more value, more profits to shareholders than any other hedge fund in the history of the market. Luckily, Ray Dalio did leave us with a really nice guide or template and how he accomplished that, which I'm going to move on to in a moment. But before I do that, I want to just define what correlation coefficients are. So correlation is really the relationship between one asset class and another, and the way that that asset class moves based on the same time period of the market or the same data. So I have the chart on the screen right now shows really these are the accessible asset classes, stocks and bonds, and there's some derivatives at the bottom and some real estate. But let's look at, let's say, commodities. So a broad commodities index, which is DBC, versus IJH, which is large cap stocks. So we can see here that they have a correlation of 0.60. So 60% of the time, commodities are going to move in the same direction as large cap stocks. Now let's go over to, let's say, real estate, US real estate, in comparison to small cap stocks. We have a lower coefficient. So 41% of the time they're going to move in the same direction. Now let's go down to gold, which is pretty commonly used by retail investors to hedge a portfolio. And we can see that gold has a 0.22% coefficient with large cap stocks. You can also see that certain asset classes are going to create negative coefficients. So I'm going to move on to the next slide and show you what Ray Dalio created using these coefficients, which was really called his all-weather model, or the all-weather portfolio. The all-weather portfolio was really just a combination of U.S. Treasuries, U.S. large cap stocks, some derivatives, and some gold. But he chose those asset classes because of their low correlation coefficients. Because what he found is that by decreasing the correlation percentage and increasing the number of assets or alpha in the portfolio, you can significantly reduce the probability of losing money in a given year. And the reason that that's true is by having lower correlation coefficients, you're reducing the drawdown potential of a portfolio. So when times are bad, you want assets that don't all go down in the same direction in the same percentage gain or loss. So when we look at the left side of this model, we see this is the y-axis. We have annual portfolio standard deviation. So standard deviation is just the primary measurement of volatility that's used for any stock or any fund or any index. So we know that S&P has a 17 standard deviation, for example, and this is just going from 1 to 10. And then on the x-axis, we have the number of assets or alphas in a portfolio. So this could be an asset class, it could be a stock, it could be a bond, it could be a private equity fund, it could be anything. We know what he was using, really those 4 asset classes that I mentioned prior. But let's say we have one asset class with that 10% standard deviation, the 10 standard deviation. We have a probability of losing money in any given year of 40%. But look what happens when we add alphas or asset classes and reduce the correlation. The gray lines are the level of correlation between asset classes. So let's say we have 6 alphas, 6 asset classes with 10% correlation. So by doing that, one, we're reducing the overall standard deviation of the portfolio to under 5. Now remember, each one of these asset classes standing alone has a standard deviation of 10, which is going to allow for upside when that asset class is performing. But most importantly, by having 6 asset classes with a 10% correlation, we're reducing our risk of losing money to about 28-29% per year, down from 40% with one alpha in the portfolio with a 10% standard deviation. So if you go to 8 asset classes with 0 correlation to one another, you're again reducing the standard deviation, which is therefore reducing the probability of losing money in a given year to well under 18%. Now you can see that when you continue to add more alphas or more asset classes, it doesn't really have much of an impact. So the sweet spot seems to be somewhere between 6 and 8 asset classes with low levels of correlation. Now we know Ray Dalio used primarily treasuries, large cap stocks, commodities, but especially these days to the average investor, or at least the higher net worth investor, there's other asset classes that can give you the upside when the overall market is doing well, but still share a low correlation coefficient with large cap stocks or the S&P 500. So if you mix in asset classes like, let's say, private equity, which already standing alone has a lower standard deviation than the S&P 500 and a higher average consistent return, but a low correlation, you're dramatically decreasing the drawdown in a portfolio, increasing the upside. Or private credit would be another great example. Low correlation to publicly traded stocks, but then by having that in a portfolio, you're going to bring that portfolio down to these 20, 40, 10% correlation numbers depending on the actual fund that you'd use. So by taking this model to the next level and using some of the alternative strategies like private real estate, real asset funds, or credit funds, or quant funds, or absolute return and hedge funds, private equity or venture capital, and mixing those assets in a portfolio that allow for the strong and oftentimes consistent returns when times are good, but that are not going to correlate with one another on a high level when the times aren't so good, is going to again continue to kind of take this model to the next level and allow for a more consistent return by missing and mitigating some of that downside risk when the market's not doing so good. So this is known as the Holy Grail model, again from Ray Dalio, which really zeroes in on correlation. And correlation is in the second dimension. It's really one of the core principles that we use when structuring a portfolio in our 3D universal asset allocation. So I hope that this was educational. It really gives a good sense on not just how to diversify, but how to diversify the right way in which asset classes that you want to use to not affect the upside return, at least not affect it as much as possible, but greatly reduce your downside exposure. So I hope this was educational. Of course, if anyone would like to discuss it with us, we're available here at Jesani Wealth Management. And my name is Andrew, and thank you very much for watching. Take care.